Hey everybody, welcome to the December Mora Group Market Update. I'm Steve.
I'm James.
Let's start with some good news. Mortgage rates, lowest levels in the last 3 months. This is due to some easing inflation numbers coming in recently, and also investors predicting that the Fed may cut interest rates sooner than expected in 2024. The Fed, for their part, they're trying to control those expectations. So we've seen some pretty conflicting statements from some Fed board members, which is not unusual. But on Friday, Jerome Powell came in and said it would be premature to conclude with confidence that we have achieved a sufficiently restrictive stance. So, really trying to kind of temper those expectations and keep things on a normal path for a soft landing. We'll see how things go from here. We have some employment data coming in later this week that could sway the market, so stand by.
With these lower rates and the expectation that the Fed will be holding off on any further rate hikes, buyers seem to be a little bit more confident in the real estate market right now. It seems that affordability is easing and that there are more mortgage applications these days. We're also noticing that buyers seem to be more apt not just to fill out a pre-approval application, but also to put an offer and follow through on a home purchase. Another positive with those rates is that we got some news last week on the new conforming loan limit for 2024. Over the past month, most lenders, most mortgage companies were speculating that it'd be about $750,000. Well, last week they announced it would be $766,550. What does that mean for buyers? Simply that they can put less down to get into a higher purchase price. And that's not just for one unit, but also two, three, and four.
One thing we're seeing a lot of these days is buyers trying to navigate non-contingent offers. So what this means is they're not selling before buying. They ask us a lot about bridge loans. Bridge loans can be structured many different ways. Essentially, the best way to go about this is if the buyer can put minimum down on their new purchase, carry both loans, qualify for both loans, and then recast their loan once they've sold their home.
Second most beneficial way would be for the borrower to throw a HELOC on their departure property. Tap into some of that equity and use that to help with the down payment. Now, of course, when you're throwing a HELOC onto a property and you pull those funds for the down payment, you're going to be creating a new liability. So now we're not just looking at the departure mortgage, the new mortgage, we're also going to be bringing into account that HELOC liability. And so we want to make sure that they can qualify with that as well.
If the borrower isn't able to qualify for those first two options, that's when bridge financing comes into play, either a cross collateral loan or a bridge loan that allows them to remove the debt on their current home, put a loan on the new home. It's more expensive, but it's an easier qualification.
The point is there are a lot of options for borrowers to look at before submitting a contingent offer. Go ahead and reach out if you have any questions on any of these. We're happy to help out.
Hey, have a great holiday season, and we'll see you in the new year.
Happy holidays.